Hey, welcome everybody. Thank you for joining me here on the podcast. Appreciate it. Well, it's Monday and the stock market is now closed. The Dow Jones down about 12 points, and it was kind of a wild ride. And we were up about 50 points this morning and then fell back down, and we were down 50 or 60 at one point and then rallied back and finished fairly flat. You can see utilities up on the day, but overall kind of a mixed day. As we scroll through here, you can see the NASDAQ telecom and insurance and banking and so forth all down slightly on the day. Russell 2000 down about 0.25%. The gold and silver index, you can see up 1.59%, so they're starting to see some movement on gold. Let's go ahead and start out talking about gold. You know, gold had broken its 200-day moving average back in mid-December. You can see it right in here. Broke right through. And after it did that, a lot of people said the bull market's over, and that's going to be it for the gold move that we've had really for the last 10 years. Now, most commodity bull markets typically last anywhere from 17 to 20 years. So here we are in about 10 years of gold. And that's going to, I said at the time, I thought that gold would continue to struggle, but I also said that I thought gold would eventually resume its bull market. So I got 1 out of 2 right because gold has turned around, as you can see, and it's heading higher at least right now. Now we do run into this overhead resistance, and you can see that I've kind of drawn that line here, which connects this. So we have to break through. So the best thing the bulls could hope for is maybe a pullback to here, and then up we go. And if that was the case, then great. Then the bull market is intact. Now, the reason I'm bringing up the stochastics, is because a lot of you use stochastics, and it's one of the things that I do watch. As you all know from listening to me for several years, I don't rely on any one indicator because there's certain times where different indicators work better than others, and there's certain stocks that react better to certain indicators. Gold, if you look at the stochastics, when it came up in this area, you can see that it went up here, and had you sold it right in here, guess what? This would have been the time you would have sold it. And at $152, of course, it went up to $184. You would have missed a 20% move. So you don't always need to use the same indicator. And the thing is, if you are going to use stochastics, look what happened. When did it finally turn the corner? It was when we really had this break below this area. So again, look for stochastics to turn down and maybe go below this green line here before you start to get negative on it. In the very short run, you could see a pullback, maybe giving up half of these gains, so maybe in the 156 to 158 area on GLD, which is the surrogate for gold, the Spider Gold Trust. If we had that little pullback, then I think you could see perhaps another run. If so, maybe we're looking for something right in here. If we get that, then it could be off to the races. But that's why also, remember, when you're looking at a 200-day moving average, this is very, very important. Look at the slope of the 200-day moving average. Did it break it on the way up or on the way down? The 200-day moving average, as you can see, is still just basically moving straight on up. There's no signs that it's turning around here. So I would be inclined to say wait for this to start to turn the other direction if you're bearish. And I'm not bearish gold. I don't have a position on gold right now, and I would rather see it pull back a little bit and then break through that downtrend line on very heavy volume. But so far in 2012, it has been one of the places to be. Now let's take a look at the overall stock market. This is the SPY, which is, of course, the Spiders, has a ton of volume, 120 million shares today. And this is really, if you want to get long the market, this is what a lot of hedge funds do. They buy the SPY, they short the SPY. It's the S&P 500, biggest 500 companies in the U.S. Now, obviously, back in July and August last year, we had this big sell-off. We were bouncing around, very, very volatile days. 4-5% moves in a day were becoming commonplace. I think at one point there were 4% moves back to back to back to back. I think that was 4 backs to backs. Anyways, and then we broke out, and of course we hit the 200-day moving average, hit it several times, and finally here, just this year, have we broken above it. So now all the bulls are coming out of hibernation, and bears are nowhere to be found. And the bulls are saying, this is great. We are heading higher. Everything looks smooth sailing. Europe is fixed, and it's off to the races. I am, and I've used this definition before, this analogy, prove yourself to me. Let's let the market prove itself to us. As you can see down here, the 50-day moving average of volume continues to decline. So yes, we've had a little more volume now than we had in late December, but of course those were the holidays. We're still getting half the volume we were in early December, so the 50-day moving average continues to fall. So what you have is you don't have a lot of stocks participating in this rally. The advanced decline line is better, but there's also a bunch of other metrics that aren't confirming this rally. Now, how do we play that? I've been saying for a while now, I think if you're too bearish or you're too bullish, that's the wrong mentality. I think getting complacent and getting too long here, you'll get bitten at some point here. And it hasn't happened yet, and that's great. I'm getting more invested this year than I've been. I've been doing a lot of smaller, quicker trades and things like VMware, which reported earnings after the bell good. Owned Starbucks for a while during the holidays, sold that for a profit, got out of Google before they reported earnings and took a nice profit on that. Now you see Google really taking it on the chin, and we'll look to get back in at some point. Locked in profits on Microsoft today. So I've been doing more trading shorter term than really investing. The only investing I'm doing, at least for the next few weeks and months, is more on the income side of things. But as far as trading, I'm still not convinced that we're out of the woods. I mean, again, when you essentially what's been happening is money is being poured into these European banks, part of it coming from the United States, and many people believe that is QE3. That's really what's going on right now, is that we are having QE3 as we speak. So that's part of the reason why you're getting this going up. And remember, I said for months they are not going to call it QE3, but I was a firm believer we would get it. Perhaps this is it in a totally different form or fashion. But money's going into these foreign banks. What are those foreign banks doing? They are going and buying at auction Italian bonds, Spanish bonds, and what's happening is those yields are coming down. Remember, when Italian yields were over 7%, there was panic. Now that they're coming down, everybody says everything's great. Well, once again, and this is probably why you're starting to see gold perk up, is we're printing more money and borrowing more, essentially, to pay off older debts, and it's just circulating. And again, I don't think any problems have been addressed. With that said, I am not overly bearish because the market is telling us to be in there for a portion of our money. It's very important for a portion of our money and to have an exit strategy. We have a ton of complacency. Obviously, my fear, greed indicator is at very low levels, showing that people have no fear. They're very complacent. If we're in a bull market, that's the right stance. If we're in a bear market, then they're dead wrong. It's very important. Listen up. If we're in a bull market, the people that aren't buying protection through puts are correct. If we're in a bear market and you're not buying protection, then you're dead wrong. So you have to start with that. But what we're seeing is kind of mixed signals in the short run. So while some people see that this is going straight up and everything's great, and others say this is all going to just collapse on itself, I see something in between. In the very, very short term, I think we are very extended. And in the medium term, the next few months, perhaps it can be good. But I still wouldn't say we're in a bull market by any stretch of the imagination. It is great that the banks are participating now, and it's great that the semiconductors are participating. Those are two areas that I've always said they must participate if we're going to have a healthy, strong market. But you can see the S&P did break through here. A lot of people are looking for, a few more, perhaps a couple of days of higher markets. I don't know if we'll get quite up to 1370, but if we get somewhere in this area, then we fall back down. And I think what the bulls would hope for is if we can get a pullback to maybe, let's call it the 1250 range, which is right here on this 50-day moving average, 1250, 1260, and bounce from there, that would be a great entry point. However, sometimes you don't get those easy entry points. And many of you, and me included in this group, are still very worried about this market, and so we're stair-stepping in. We're getting slowly invested, and that means there's still cash on the sidelines. And as it goes higher and higher, more of that money must come into the market. But you've been seeing areas like financials, XLF, kind of the biggest ETF out there as far as financials are concerned. We've seen that, and here's maybe a logical spot which we're getting close to. So again, financials are leading the way. We also have what's lagging this year. Staples. Take a look at what happened to some of these stocks like, and I'll zoom in here in the last, we'll call it 3 months. Look at Procter & Gamble. Procter & Gamble reached a high of $67, down to $64.80 today. I think Clorox, again, another day turning the corner here. The utilities, which have been great, look what's happened this year. Year to date, look what's happened. $36 down to $34. Not a huge move, but certainly underperformance. And then, of course, if you go to the discretionary stuff, it's going through the roof. So you've got a rotation that's happened in 2012 out of safe stuff, and now it's risk on all of a sudden. I would play the middle, and I would do that. And what that may mean is that you lag the performance of some of these indices, but if you look at your risk-adjusted return, you will be much, much better off on days where the market falls 50 or 100 or 200 points, which we haven't seen that yet, have we? We haven't seen big, big down days. We've seen them, and then they were erased maybe, but we haven't seen a down day to scare people. And we're getting to the point where the volatility index, which is the VIX, is, you can see here from the picture, and I'll zoom out a little bit, it's getting way, way, way oversold. So we could get a point where, again, if you're wanting to buy protection, puts and so forth, this is the time to start averaging into those. At the very least, if you don't do options, look at locking in some profits on some things, or certainly keeping some stops on those other things, because this is not a market to still just throw caution to the wind and say, what, everything's going up. I feel good about stuff. I'm more confident now than I was 6 weeks ago. I'm going to sacrifice my retirement and put it all in to the stock market. That's not the right attitude. However, for those that are ultimately very, very bearish and don't trust anything that's going on out there, there's nothing wrong with participating with an exit strategy. Okay, that's what I would say. So I'm participating. Am I participating as much as I would like? No, right? We all want to participate 100% when it's going up, and we want to participate none when it's going down. And actually what's happening right now is you're getting the market going up. And remember, the first 5 days of the month were up, and 87% of the time, I believe, the stock market is up for the year. So the bulls have that going for them. They have the fact that the dollar is going up. They have the fact that now in the last few days, the euro has turned around. And I know some people that capitulate and actually start shorting the euro just after it started to go down. These are all things, you're starting to see interest rates go up. So you're seeing all these things that weren't working the last few weeks of the year last year are working right now. And it seems too convenient to me that the calendar changes and all of a sudden the world got better. So I would say cautious, but still participate. And again, don't forget that income. I think that's something that I'll continue to drive home. Okay, folks, it's time for the screen of the day, or the week, or the month. I guess it just depends on when I do it, right? But we all know that the dollar has been going up. And when the dollar goes up, that's generally bad for companies like, the Caterpillars, McDonald's, Coca-Cola's, Procter & Gamble's, the companies that have most of their sales overseas because they have to convert it back into dollars. Dollars expensive, and they don't make as much money. So in a rising dollar environment, which I'm not sure that will continue, but for right now it is working, what you want to look for is companies that have most of their revenue inside the United States of America. And as I see on the screen here, I've got companies that have let's call it 85% or more of their revenue comes from inside the United States, and I've got it sorted by market cap. So you can see United Health, UNH, Express Scripts, Marathon, Time Warner, McKesson, Aetna, Northrop Grumman, Humana, Discover, and Cigna are the top 10 as far as size. And you can see how their stocks have performed this year in this column right in here, up somewhere between 1 and 7%. And basically, again, if you believe that the dollar is going to continue to go higher, then you have to start incorporating some of these companies that don't get their sales from outside the United States. They're not benefiting necessarily from China. They're not affected from Europe, which is another benefit of owning them. But look for some of these companies because some of them have done very well the last several months, even when the dollar wasn't going up, but especially now that the dollar's going up. That will impact their earnings positively. So, again, these are companies that have a lot of the revenue inside the U.S., and I may have added some other screens on here as far as cheap companies also. So these are companies that have been screened for a lot of revenue in the U.S. and they're fairly cheap. So take a look at this one here, and this is probably one that you may have trouble doing on your own because it's hard to get that. Where does their revenue come from? Fortunately, my Bloomberg machine does that for me. So anyways, have a wonderful day, guys. Appreciate it. Thank you all for listening, or in this case, watching. Don't forget, twitter.com/Carl Eggers. I haven't been updating as much. I've just been busy lately, but I'll try to update that throughout the day, every day. And, of course, carleggers.com, eggerscapital.com, Google plus Carl Eggers. Google continues to get more people to convert over from Facebook on there. Take care, everybody.